Hello and welcome to Moving Iron Podcast Tax Moves with Glen Birnbaum. Glenn, what's up, buddy?
Not too much, Casey.
Um,
I'll think we finish with beans maybe tomorrow. So
well, there you go, man. Then summer vacation starts, right? You take the rest of
that's
that
right.
summer off.
There you go.
All right, man. So last week we touched on a little bit of if you were going to get out of farming and you're going to sell off all your stuff and move to town, what that would look like. And you brought up a
Yeah.
tool here you can use called farm income averaging.
Farm income averaging. Yeah. So I think in future podcasts we'll talk about other techniques. If you're getting out of farming, because there's several different ones. But today we're just going to focus on farm income averaging. And basically, this is something that's available, just to farmers, also fishermen. So it's pretty unique. But basically, it says, if I sell out in 2018, right, I'm a farmer. You might think, well, I've got to pay tax, based on the 2018 tax rates, whatever they are. Well, actually, you can use this farm income averaging rule. It's an election. You don't have to do it. If it saves you money, obviously you're going to do it. So it's an election to take the income in 2018 if it's farming income, and you basically divide it by 3, and you basically get it taxed at the 3 prior years. So if we're talking 2018, you would take it back to 2015, a third of it, 2016, a third of it, and 2017, a third of it. So if you're in a lower tax bracket in those prior 3 years, it would save you tax. So it's pretty unique. Now, one thing, Casey, is tax reform passed last December. Generally speaking, tax rates are lower in 2018 as a general rule. So typically, it may not make sense to do it, but in the situation that it probably for sure is going to make sense is if you are getting out of farming. You're selling all of your equipment, your grain. So it's a pretty nice thing to be able to use prior tax rates that are hopefully lower than your current year rates.
Okay, so if that would be that was my question I was going to ask you with the new tax rates and how that works. Is it beneficial to do it all in 1 year, or should you definitely go back to the 3 year period, or is it just a individually based thing?
Yeah, so it's not super flexible. You basically, if you're going to elect, hey, I'm going to elect $120,000 of farm income, to be subject to this farm income average, and you have to put $40,000 in 3 years ago, $40,000 2 years ago, $40,000 1 year ago. So you can't really pick and choose how it works. But it is an election. So as far as tax brackets, though, Casey, generally speaking, in 2017, it was about $75,000 of income. That was a key break point, taxable income of $75,000. And you went from a 15% bracket if you're below that to a 25% bracket if you're above that. So that's a 10%, difference. So a lot of times you try to watch that, right? Hey, do I want to be over this $75,000 of taxable income? So again, that was a 25% rate. Now, roughly in 2018, it's about 77,000. So it's about the same number. But it goes from 12% to 22%. So it's still 10 extra points. But, bottom line is it's only a 22% rate in 2018, and it was a 25% rate in 2017. So that clearly shows, hey, there are lower tax rates. So, again, farm income averaging probably not going to be used a whole lot if you're just, ongoing in farming. But if you're going to be selling out and have a big income in 1 year, it's definitely something you'd want to use and consider.
So would this be, for example, like last week we were talking about the first $24,000 of income?
Yep.
Would that count into this? So if you had $124,000 worth of income, that first you basically be taxable at $100,000.
Right. Yeah. So that 75,000 rough number, we're talking about $100,000 of what we call adjusted gross income, which is what most people think of their income. So, if you make $100,000, hey, I'm only going to be taxed on about $75,000 in income, and that's going to be at that, lower rate. So it's still it's only 12%. If I'm at 77,000 taxable income, that's only 12% rate. So
Right.
It's pretty nice because that's really more like 100,000, 102 or whatever.
Right.
So.
Okay.
Now, the types of income that qualifies, it's really, it's got to be farming related. It cannot be, I checked this out, it cannot be like a custom harvesting operation, right? You've really got to be engaged in actually farming But, grain sales count, equipment sales, gains on sales of equipment, so again, if you're selling out at auction or something, that would be eligible. The one thing that's not eligible is land sales. So if you have gains on sale of land, that is not farm income, eligible to be farm income average. So, but the two biggest ones are equipment sales and just your final year grain sales. Those are eligible to be taxed at this lower rate if it's available. So definitely something to keep in mind. Now, it doesn't change anything with self-employment income, anything like that. Self-employment tax is not affected by farm income averaging. So, but this can definitely help out if you're in your final year or two.
So how would that work with like land? Does that fall under more of the capital gains part of the
Yeah,
law?
land would be a capital gains rate, which isn't a terrible rate. It's generally about 15. Well, it actually could be 0% if you're under roughly that $75,000 taxable income number. It could actually be a 0% rate. But most times land sales is going to be pretty significant, so you're going to be over that. So then it gets into about a 15% rate, and then it can reach a 20% rate once you're into the around $450,000 income. So bottom line, it's probably usually about a 15% federal rate. So it's lower than ordinary income grain sales typically, and obviously land sales aren't subject to self-employment tax.
Right. So would the so you mentioned custom cutters in there, and they weren't that they can something like this wouldn't fall under their umbrella. But for example, let's say we have a customer that is a custom harvester. They do some custom planting and some custom harvesting, but they also farm. And they have two different entities, I think. But anyway, hypothetically, they got two different entities. One is eligible and one's not. Is that how it works?
Correct. Yeah.
Okay.
Or if it was combined, you'd really have to allocate it. With what are my expenses associated with the custom revenue, and so it's. It kind of makes sense, right? They're wanting to give the break to somebody that's actually subject to the whims of the prices and the yields, right?
Right.
Versus just kind of being hired to plant the crops. So.
Right. Okay.
A couple other things is that actually a landlord who crop shares. So we're talking about crop share income. The income is variable. A landlord who crop shares is eligible to use this farm income averaging. Again, obviously, if it would save them tax. So now the one thing is it has to be a written lease agreement. The IRS is pretty strict on that. It has to be a written lease agreement, and the lease needs to be signed prior to when any sort of significant tenant activities would start. So in our area it might be typical March 1st or whatever. So you can't hey, sign this lease retroactively. So again, even a landlord who's crop sharing, we're not talking about cash rent, but a crop share landlord can benefit from farm income averaging as well.
Okay. So. That's a good clarification because most people wouldn't think about that.
Yeah, you don't think about it. Again, if you got a really big spike in income one year, it's something to think about. Is you're not necessarily constrained to the tax rates and brackets that are in effect for 2018. You may be able to use the tax rates and brackets for the prior 3 years if you can follow these rules. So
you can do this anytime you want to, not necessarily if you're going out of business, but if you have a significant year, you can just do it whenever you want.
Correct. And sometimes you do try to maybe spike your income. It can be a little hard, but you could say, hey, I'm going to spike my income up, and just because I know I'm losing a year, right? Hey, I've got a bracket that's available, right, and it's going to fall off next year, and I want to get my income taxed, at a certain, there's a 15% bracket still sitting there, or there's a 25% bracket still sitting there, and I'm in a higher bracket now, because my farming operation has expanded, what have you. But you deliberately, get your income up just to take advantage of that bracket before it goes away. So it's an interesting way of thinking. The other thing, Casey, is your tax software will do this. We use software, but the software you got to be careful because the software pretty much assumes if you're a farmer that you're never going to make another dollar in the future. So it says, hey, don't do anything. Don't elect farm income averaging because it assumes you have no carryover income, no future income. So there's definitely times where we look at it and say, hey, the software isn't really doing this right. I could actually do a farm income, elect it. It actually doesn't change my tax $1, So you might say, why am I doing it then, right? If it doesn't change anything, but what it does is it leaves open more lower brackets, right? So in other words, if I'm going to get taxed at 15% either way, well, I might as well get taxed at 15% using the brackets from the past. That leaves more 15% bracket available in the current period for future. So you really want to make sure you talk to a tax professional on this and don't just rely on the tax software.
Right. And then what constitutes a farmer? Like how many dollars of cash receipts or whatever it is does it have to?
No, there's really no, it's, you know, you've got to be engaged in it for profit, you know, there's some hobby rules and stuff, but it's, you know, anybody that's really farming, that's got grain sales is eligible. Yeah, there's not a certain size. You've obviously got to have profit to be able to elect to average it.
Right.
But yeah, it can be just a little bit of your, you know, you could have off-farm income, a lot of other income, but if I've got a little Schedule F that I'm doing, that, you know, that's eligible for farm income. So.
Okay. All right, Glenn. Well, anything else that you want to say before we shut it down here?
No, I don't think so. Again, we'll talk some more about some other techniques in later podcasts. But definitely, you know, ask your tax professional about, hey, does it make sense to use farm income averaging, even if it doesn't change my tax at all in the current year, because it might save money in the future. So,
all right,
that's the takeaway.
All right, Glenn. Well, if guys want to get a hold of you, how would they do that?
Well, our phone number here at Hienold Banwart is 309-694-4251. You can look at our website, www.hbcpas.com, and check me out on Twitter at Glen Birnbaum.
All right, Glenn. Well, it's always a pleasure talking to you, man. So we'll talk to you next week.
Okay, Casey, good to talk with you.
Thanks, man.